The Jared Dillian Show.
I'm Jared Dillian. This is the Jared Dillian Show. If you want to call to talk about your money, please call 844-305-7800. That's 844-305-7800. This is the Jared Dillian Show. I talk about mutual funds a lot. In fact, I just did a couple seconds ago, but I never really take the time to explain what they are. So what is a mutual fund? And I have a definition here. I don't know where I got this definition. A mutual fund is a type of financial vehicle made up of a pool of money collected from many investors to invest in securities like stocks, bonds, money market instruments, and other assets. Mutual funds are operated by professional money managers who allocate the fund's assets in attempt to produce capital gains or income for the fund's investors. A mutual fund's portfolio is structured and maintained to match the investment objectives stated in its prospectus. Mutual funds give small or individual investors access to professionally managed portfolios of stocks, bonds, or other securities. Each shareholder, therefore, participates proportionally in the gains or losses of the fund. Mutual funds invest in a vast number of securities, and performance is usually tracked as the change in the total market cap of the fund, derived by the aggregating performance of the underlying investments. So I want to just go through this a little bit. It's a financial vehicle made of a pool of money. So you combine your money with a bunch of other people and you have a pool of money to invest in stocks and bonds and stuff like that. They're operated by professional money managers. People who got MBAs from Wharton, people who have the CFA, people who have devoted 20 to 30 years of their lives working in the stock market. They have a prospectus. When you invest in a mutual fund, you get a prospectus. It talks about the objectives of the fund, and it has a list of the holdings of the fund. It's a pool of money that invests in stocks or bonds. Now, let me just be clear. The best way to get started in investing is in mutual funds. Now, the mutual fund industry has been in decline for the last 20 years. It's not good. It's not good for the mutual funds. ETFs are becoming more popular. I don't like ETFs as much. Keep in mind that I was the head of ETF trading at Lehman Brothers. And I'm not as much of a fan of ETFs because they're easier to sell. And you don't want to sell your ETFs. You want to hold them forever. The structure of mutual funds allows you to hold them forever. Now, there's two different types of mutual funds, and the vast majority of them, about 99%, are what you would call open-end mutual funds. Okay? When you buy an open-end mutual fund, and just for example, a fund at Vanguard would be an open-end mutual fund, the Vanguard Energy Fund or something like that. If you send them a check for $3,000, they invested in their fund, they get the cash, and you get shares in the fund, and you'll get a fractional number of shares. And then you participate proportionally in the gains or the losses of the fund. It really is one of the greatest financial innovations of all time. Then you have something called a closed-end fund. Closed-end fund is also a mutual fund. It trades on an exchange. It's a mutual fund that trades on an exchange. But the problem with closed-end funds is that the price of the stock can vary quite a bit from the net asset value of the fund. And the net asset value is what it's actually worth. And sometimes you can buy closed-end funds for cheaper, and sometimes they're more expensive. It can trade at a discount or it trades at a premium. This introduces a level of complexity into investing that is not really what I would recommend. And they also have ETFs. ETFs are exchange-traded funds. ETFs are a different structure altogether. They're technically not mutual funds. I don't like stuff that trades on an exchange. I don't like stuff that trades on an exchange. And the reason is you'll have the ticker in your phone and you'll be checking it every 5 minutes. And that there's such a thing. I have this belief about information when it comes to your portfolio. And there's such a thing as too much information. If you have real-time information on your investments, it's going to cause you to make bad decisions. If you only check your investments every month or 3 months or 6 months, it's going to cause you to make good decisions. Okay? That's why the open-end mutual fund structure is so good. The fund reprices once a day, and you don't stare at it all the time. You hold it for the long run. And keep in mind, mutual funds, open-end mutual funds, do not trade on an exchange. You buy them from the issuer. So I'm a big fan of open-end mutual funds. So let's go through what are some mutual fund companies. Now, the biggest is, well, there's BlackRock, there's Vanguard, there's Fidelity, there's T. Rowe Price, and Janus. So exclude BlackRock for a second. So Vanguard, Fidelity, T. Rowe Price, and Janus. They have what's called no-load mutual funds, which means there is no sales charge, there's no expenses when you buy the funds. They have an expense ratio, which is the ongoing management fee that they charge to manage the fund. But when you buy the fund, there are no expenses. Now, there are some funds that charge expenses, and those are called load funds. And you might say to yourself, why would I pay for something when I can get it for free? Why would I? And we're not talking about small amounts of money. I mean, if we're talking about mutual funds with loads, they can often be 3%, 4%, 5%, 6%, but let's say they're 3%. You have a choice between a no-load mutual fund and a load mutual fund. I mean, and if you put in $100,000 into this fund, we are talking about $3,000 in expenses. So why would you pay for something if you can get it for free? Loads are not necessarily a bad thing. In fact, loads can be a very good thing. And the reason that they're a good thing is because they keep you invested. So just for example, you invest $100,000 into a load mutual fund. You pay a $3,000 sales charge, so you end up investing $97,000. Okay. The longer you hold that fund, you will amortize that sales charge over time. So you paid 3%. If you hold it for 10 years, it only ends up being 0.3% per year. If you hold it for 30 years, it ends up being 0.1% per year. So you amortize it over time, and the way it works is if you keep that money in, all you're paying is the expense ratio. There's no additional sales charges. If you take that money out and then you decide you want to put it back in, then you have to pay the sales charge all over again. It discourages the trading of your mutual funds. And you do not want to trade your mutual funds. You want to invest in them and hold them over time. So there's some mutual fund companies that have load mutual funds. One of them is PIMCO. They predominantly have bond funds. One of them is American Funds. One of them is Thornburg. And lots of people, when they want to invest in mutual funds, they only look for the no-load funds. Now, the load funds you typically can't invest in on your own. You have to get them through a broker. And the purpose of those loads, those sales charges, is to pay for the distribution of the funds. Okay. So, for example, Edward Jones is the primary means of distribution for American funds. And in the company that runs American Funds is Capital Group. They're based in Los Angeles. So they pay Edward Jones to distribute those funds. If you're going to have a fund for 10 years, choose wisely. You do not want to be trading it around. And remember, here at the Jared Dillian Show, we are not afraid of paying fees. Okay, we are not afraid of paying fees. Fees do eat into your performance a little bit, but that is really not, that's not what's going to determine your investment performance in the long run. So high fees tend to discourage stupid behavior. And this is all better than investing in individual stocks. If you invest in individual stocks, there is a chance you can do much better. there is also a chance that you can do much worse. For most people, you should not be messing around with individual stocks because individual stocks really is a rich man's game unless you're just truly screwing around and you're thinking of this as an education in the markets. My recommendation is to let the professionals pick stocks. And these guys are good. And if you've heard of something called the CFA is the Chartered Financial Analyst designation. Pretty much anybody who works at a mutual fund company has to get a CFA, and it sucks. You have to take 3 exams. It's a 3-year process. You're willing to put yourself through 3 years of this. You have to be dedicated. Of course, I'm not sure you learned anything from this process, but hey, you did a lot of work. These guys also earn a lot of money. It is a high-pressure job. They rank the mutual funds, and if you are in the bottom, then you suck, and then you get fired. There is a lot of competition in the asset management industry. So it's easier than ever to do this. You really have no excuse. You go on the internet. Let's say you go to Vanguard. They have a list of funds. You pick out a fund. You link up your bank account. It is a piece of cake. I had an assistant last year. I helped him do this. It's a very easy process. And before you do this, remember, build up your emergency funds first, which is $10,000 or 6 months of expenses, and you must have no debt. I'm Jared Dillian. This is the Jared Dillian Show.
The Jared Dillian Show.